Okay, so before I talk more about how to profit from this fantastic opportunity from the potential rebound of oil prices, do read the risk disclaimer. Pause the video, read it, understand it, and then continue. Okay, great. So the question you're going to ask is, what is the cost of producing a barrel of oil? Okay, because once we know the cost of production, we will understand that prices have to eventually rise above the cost of production for producers to make a profit. If not, they're going to go bankrupt. All right, so temporarily, some of them are already going bankrupt, they're suffering, but eventually prices have to go above those levels. Now, it depends on which country. Brazil is able to produce at $49 a barrel, Canada at $41, the US drillers at $36 a barrel, and for US shale oil producers, it's a bit more expensive because they have to, again, go through a chemical process of cracking the shale rock and extracting and making oil. So that costs up to $70 per barrel. So they were making money when oil was at $100. But obviously now at $30, $27, they're gonna lose a lot of money, or they're losing a lot of money. Now, Saudi Arabia, where oil is extremely easy to get, it's only $10 a barrel. Now, why will oil prices eventually have to rebound from these prices? Because simple economics, when prices are low, demand increases, right? So in fact, it was reported recently that China has been ramping up their oil purchasing to take advantage of lower prices. So as a result, they are buying more oil. So as demand should increase, it will suck up the supply faster, and it's really happening right now. Next, eventually there will be production cuts, which will reduce supply. Why? Because half of the US shale oil producers would probably go bankrupt by the end of the next 1 to 2 years when their cost of production is $70. And once OPEC, which is basically the Arab states, once they come to a consensus that they have to cut production because even though their cost is $10, but right now at $27, they're making too little money and they can't finance their expenses, their government spending. So eventually they will have to cut production and the market will eventually hit higher as this excess capacity is used up. In fact, the IMF, right, International Monetary Fund, warned that most countries in the Middle East will run out of cash within 5 years if oil prices don't rise above $50 per barrel. And most analysts expect prices to average $40 a barrel, the range about 40 to 50 in 2016, before heading up to $60 to $90 thereafter. So you can bet there's a huge opportunity right now. So I call it the opportunity of the decade, the next 10 years, right? Because I can tell you that in your lifetime, in the next 20, 30 years, you'll probably never ever see oil go to these levels again. I believe so, right? So how do you profit from this oil rebound? How do you buy oil? Well, basically there are three ways. The first way is to buy oil ETFs. ETFs are exchange traded funds, which you can buy through the stock market. And there are many ETFs. One of the ones that I can talk about, I'll just use the word recommend. One of the ones which I'm buying using ETF is called the USL. It's an ETF that tracks oil prices. So as oil goes up eventually, so will the price of the USL ETF. So take a look at this chart. This is the USL, or the oil ETF, and it was at 50 bucks. Yeah. So as oil prices collapsed, this ETF followed as well, all the way down to now $14.59. So when oil prices rise back up, this ETF will follow, right? So if I buy it at $14.59, it goes back to 50 bucks, I'm making a lot of money. So that's one way, buying oil ETFs. Again, it's not a recommendation. I'm sharing it for educational purposes. I'm buying it, okay? The second way to profit is indirectly. Instead of buying oil, we buy the oil companies. Since oil collapsed, these energy companies, oil companies, collapsed as well, for obvious reasons, right? So when oil goes up, the energy companies will rebound. So I will buy the biggest energy companies, the strongest ones that will survive, because the weak ones will probably go bankrupt and die. What are the biggest ones? ExxonMobil, Chevron, Phillips 66, ConocoPhillips. In fact, Warren Buffett himself has been buying a lot of Phillips 66 shares recently. And again, the way we buy it is basically through a stockbroker. And that's what we teach in our live trainings as well as my books. All right. So example is a chart of ExxonMobil XOM. You can see it was going up very nicely. When oil started going down, boom, from $105 to $75. Undervalued, very undervalued opportunity to buy ExxonMobil really cheap. Here's another one, Chevron, another oil company, from $135 to $82. Undervalued, cheap. The third way to profit, now if someone says, I don't know which one to buy. Do I buy ExxonMobil? Do I buy Chevron? Well, the answer is you can buy all of them. Buy all the energy companies into one by buying the energy sector ETF, known as the XLE. So that's why I'm buying as well. So this XLE chart shows you, again, the market, it was going up. When oil collapsed, it went from $100 to $54. So this ETF, when I buy it, comprises of all the major oil companies. In fact, about 40 of them roll into one ETF. So that diversifies your risk in case one of them doesn't recover, all of them on average would recover. So what's the strategy to profit? Now here's the problem. You never know where's the absolute bottom, right? It can keep, although it's cheap now, it can keep going lower and lower and lower, right? But you know that in the long term, it will always go up, okay? So there are a few strategies which a person can use. The first strategy is known as long-term buy and hold strategy. In other words, you invest with the intention of holding for at least the next 3 to 5 years, because you can bet in 3 to 5 years it will be higher. But in the meantime, it can go lower. Okay? So a way to do is to just invest a fixed dollar amount every 3 to 6 months. For example, you invest $5,000 or $1,000 every 3 months, and you keep averaging the price, keep investing the same dollar amount. For example, if the ETF is now at $15, you buy $5,000 worth of shares. Say in a month, it goes even lower to $12. You buy the same $5,000 amount. So you buy more shares at a cheaper price. 3 months later, it goes higher, buy the same amount of, the dollar amount of shares. So you average your price, called dollar cost averaging. And you can bet in 3 to 5 years, you'll probably be very profitable. Okay, so that's one style. Another style is to only buy when the uptrend is confirmed. Remember that prices move in trends. This is an uptrend, this is a downtrend, and that's the uptrend. So using trend following, we never want to go against the trend. So currently, oil is on a downtrend. So you may not want to buy while it's on a downtrend. You want to wait for an uptrend to be confirmed. So how do you know the uptrend is confirmed? Well, if you watch my other videos and you read my books, you know that a simple technique is to use a moving average crossover, which is this 50 and 150 moving average, the blue line and the green line. Simply put, when the blue line is above the green line, it's an uptrend. And both moving averages must be sloping up. When the blue line crosses below the green line and both lines are sloping down, that's a downtrend. So you can see over here, if I can just zoom in a bit, although the blue crosses below the green, but the green is sloping up. So it's still an uptrend, it's not a downtrend yet. But over here, when the blue crosses below the green and both are sloping down, that's a confirmed downtrend. So you have to sell here before the market collapses. And you never want to buy while it's on a downtrend, because low can get lower, cheap can get cheaper. You always want to wait for a reversal where the blue crosses above the green and both are sloping up, and that's when you buy. So using this technique, you may not buy at the absolute bottom, but you definitely buy the moment the trend is confirmed and you make a lot of money as it goes up. This is a second method. The last method which can be used, and before I show you the last method, let me just show you this chart again. You can see currently using the blue and green line, which I like to use. Oil, this is the oil ETF, is still on a downtrend, where the blue is below the green. So I will wait for the blue to cross above the green before taking an entry. The third strategy is one I teach at my professional trading course, which is short-term Piranha trading, where I buy even while it's still a downtrend because I anticipate the change in trend even before it happens. And I don't really have the time to explain the whole strategy for you here, but to give you an example, I look at things like oversold indicators, candlestick patterns, and I use very tight stop losses. So you can see that the USL price is going down, all right? But this Williams percentage R indicator is below minus 80, which tells me it's oversold and due for a bounce. So the moment I see a bullish candle that closes above the swing low candle, I buy it straight away. In fact, I've already bought it recently, all right? And I place a very close stop loss. So if it fails, I'm out very quickly. But I buy here with a short-term profit target at the 50-day moving average and a second profit target over here at the 150-day moving average, the green line, which is not shown but is there, and target 3, which is the 200-day moving average. So I am taking $1 of risk to potentially make about $5 to $6 to $10. 1:10. That's a great return. And the moment the blue crosses above the green, I will hold it for the long term. So this is a very quick explanation of how I profit tremendously from the markets and how my students can as well. And there's so much more to learn. This is Adam Khoo's Investing Insights. I hope you learned something. Stay tuned for more opportunities in the markets.